All right, welcome to our explainer. Today, we are tackling a word that you've definitely heard thrown around, probably in connection with some pretty high-stakes finance and maybe even a global meltdown or two, derivatives. But to really get what they are, we're not starting on Wall Street. Nope, we're going to start in a field.
So what on earth could a farmer from the 1800s possibly have in common with a trader on a slick, modern trading floor? Well, the answer is the one thing that probably keeps them both up at night: risk. And the solution they both use is a seriously clever tool that was invented way before computers were even a thing.
You see, the story of derivatives doesn't start in some glass tower. It starts out in a field, with a problem that's basically as old as farming itself: the total, complete uncertainty of the future.
Okay, picture this. You're a farmer back in the 19th century. You work your tail off all year long, and then harvest time comes. The problem is, you and every other farmer are bringing your grain to market at the exact same time. This huge flood of supply hits all at once, and bam, prices just crash through the floor. So to fix this, the Chicago Board of Trade cooked up something absolutely revolutionary: the to-arrive contract. It let a farmer lock in a sales price months ahead of time. Just like that, the risk of a price crash was shifted from the farmer to a buyer who was willing to bet on where prices would go.
And that to-arrive contract? That was one of the very first derivatives. See, the contract itself doesn't have any real value on its own. Its value is derived from the future price of something else, the underlying asset. In this case, that asset was grain. And that's the key idea behind every single derivative today, whether the underlying thing is corn, oil, a company's stock, you name it.
Now, it doesn't matter how complicated these things get. They all basically fall into two big families, and the difference between them is, well, it's everything.
It really just boils down to this: is the deal an absolute, no turning back obligation, or is it a right that you can choose to use or not? A forward commitment is like signing a legally binding contract. Both sides have to follow through, period. A contingent claim, though, is more like buying a ticket to a concert. You've paid for the right to get in, but hey, if you decide you'd rather stay home, you don't have to go.
So that farmers to arrive contract we talked about, that was a type of forward contract, a textbook forward commitment. The farmer was obligated to sell his grain, and the buyer was obligated to buy it at that price they agreed on, no matter what the market price ended up being on delivery day. It's a firm deal, locked in stone. An option, though, is the perfect example of a contingent claim. With an option, you pay a little bit of money up front, it's called a premium, for the choice to do something later. Think of it like putting a deposit down on a house. You've bought the right to buy that house at a set price, but if you find a better one down the street, you can just walk away. You only lose your deposit. You have the option, the power to choose.
Okay, so where do these deals actually go down? Well, they happen in two very different places: the public exchange and the private, well, street. Right. So you can trade derivatives in two main ways. First, on big formal exchanges, like the Chicago Mercantile Exchange. Here, everything is standardized and the exchange itself acts as a middleman, guaranteeing the deal. So there's basically no risk of someone bailing on you. The other way is called over-the-counter, or OTC. These are totally custom, private deals made directly between two parties. That gives you a ton of flexibility, but it also comes with a big risk. What if the other side can't pay up when the time comes?
I know, this can all sound pretty complex, which brings up a really important question. Why do we even need these things in the first place? Why not just, buy and sell the actual assets?
Well, they serve some really powerful purposes. The biggest one, like we saw with our farmer, is managing risk. Just moving risk from someone who doesn't want it to someone who's willing to take it on. But they also help us figure out what the market thinks the future might look like. And honestly, on a practical level, they're often just cheaper and easier to trade, and they help make markets more efficient by letting people act on information really fast.
But all that power and efficiency has a dark side, or at the very least, a hugely controversial one that people have been fighting about for decades.
And this gets us to the heart of the whole debate. Critics will tell you derivatives are just a giant legalized casino, a way to place massive bets that can throw the whole system out of whack. But the defense is pretty simple. For every farmer looking to get rid of risk, you need someone, a speculator, who's willing to take on that risk, hoping to make a profit. These speculators are the ones who provide the money and the action that makes the whole market work.
And to really get why this argument is so intense, you have to appreciate the absolutely staggering, mind-boggling size of this market. It's only gotten bigger over the last decade.
The original source for this explainer said the market was already over $600 trillion years ago. Well, we updated that research. By the middle of 2023, the value of just the private, over-the-counter market had swelled to, get this, $715 trillion. And no, that is not a typo.
And that colossal number is what gets to the core fear. The danger isn't just that one trader loses a bunch of money. The real worry is that in a market this huge and interconnected, one big failure could set off a catastrophic domino effect. It's what economists call systemic risk, and it's the very thing that almost brought down the entire global financial system back in 2008.
So at the end of the day, we're left with this huge fundamental question. Did a simple tool invented just to help a farmer sleep a little better at night evolve into an absolutely essential part of our complex global economy? Or has its incredible scale and complexity created a monster, a threat that's bigger than any of its benefits? That's the question, and it seems like the world is still trying to figure out the answer.